It has to do really with personal income and a lack of progress potentially over the next couple of months in Chinese consumption. China has been the great relative beneficiary of the way that the COVID crisis evolved over the last 6 months. China has a positive GDP growth of about 5% compared to probably the best was in the US, which was merely a minus 2.9% year on year, with -4 being quite typical for Europe and some of the emerging companies. You're looking at minus 12, minus 15 for places like Brazil, or -9 for Mexico. So China actually has an economy right now that has moved from around 13 trillion in output to 14, whereas Europe fell back from nearly 14 to 13, and the US has actually shrunk some from around 22 to 21. So we have seen China outperforming, China's economy growing, and they're actually a bit ahead of the rest of the world in the global cycle uptick that our research has been showing for this quarter and continues into next. And so it's relative positions and changes to come over the next couple of months. Also, it's unlikely that the Chinese will be able to continue applying the kind of monetary stimulus that we've come to expect from those authorities, just because there is beginning to become apparent some upward pressure on house prices that look to be of some concern to the Chinese monetary authorities. So it's in terms of relative performances in particular that we think there is less opportunity in the Chinese markets than in the US. I would also go ahead. Yeah.
Sorry. No, I was just going to say, how much does relative valuation play into this then? Not very much by the sounds of things. I was looking at the MSCI Emerging Index on a cyclically adjusted Schiller Cape price earnings multiple, 13.7. When you compare that against where we are in the US at over 30, there does look to be a relative valuation argument for EM and some of these Asian markets, but I don't hear you focusing on the value opportunity. You seem to be more focused on the potential for stimulus.
Yeah, I'd say that's fair enough. And I'd also say that we're looking at, 30 times for the US. You can have even more. The UK is barely able to calculate how many times we have cyclically adjusted earnings. But those are coming off a contraction in the US of 30% for earnings. And then the latest ones are more like 7% for earnings. If we look at where forward earnings are, in other words, how are things being adjusted for where we think we'll be over the coming cycle? The US drops to about 20 times, so does Europe. China, you're right, it remains at about 15 times, and the UK is at about 15 times forward earnings. So there is some expectation that the very poor earnings and that those real contractions that we had in the second and less so in the third quarter will be behind us, and that things are normalizing. That's how I would look at those particular valuations.